This module is on incremental analysis in the decision-making process. Now, as I said before, managerial accounting or management accounting is about planning, control, and decision-making. This module, we are discussing decision-making. We're going to identify the steps in the decision-making process, introduce the concept of incremental analysis, identify what we call relevant costs, and we'll define what relevant means, in accepting a special order, identifying the relevant costs and make and buy, or the relevant costs and consider repairing, retaining, or replacing equipment. The management decision-making process involves a number of the following steps. First of all, identify the problem and assign the responsibility. Then determine and evaluate the different courses of possible action. Make a decision and then review the results. So, incremental analysis involves a choice among alternative courses of action. In making such decision, management ordinarily considers both financial and non-financial information. And the process used to identify the financial data that changes under alternative courses of action is called incremental analysis. And it involves the possible effects on the decision on future earnings. And the data that we're going to use involves uncertainty because we're talking about the future, and estimates. We're going to involve market analysis, engineers are involved, accountants are involved. And we're going to focus both on costs and revenues because both can change. And don't fall into the trap that a variable cost changes and a fixed cost doesn't. A variable cost may not change out costs. Here's an example. We have two alternatives, A and B. Now, the cash in for alternative A is 125. The cash in for alternative B is 110. So there is a decrease in the cash coming in of 15,000. But the cash going out, 100,000 for alternative A and 80,000 for B. So there's a cash savings if I choose alternative B. Cash coming in is greater, or cash going out, so my net income is greater. Therefore, the effect on net income will be an increase of 5,000. So in this case, I would choose alternative B. Now, there are a number of different types of decisions that managers face that involve incremental analysis. We're going to look at accept or reject a special order, make or buy decisions, retain or replace equipment, eliminate an unprofitable business segment. To begin with, accept a special order. Sometimes a company may have an opportunity to obtain additional business if it is willing to make major price concessions to a specific customer. A special order should be accepted basically if the cash in revenue, incremental between the two, exceeds the cash out, the incremental costs. Now, a couple of assumptions. First, it's assumed that if I accept a special order and give a discount to this one-time customer, my other customers will not find out. Otherwise, it would be a very serious problem for us in losing market share. And lastly, it's also assumed that I can produce this extra product without increasing my plant capacity, adding equipment or having to expand the existing plant. For example, let's assume we have Sunbelt Company. They produce 100,000 automatic blenders per month. And they are currently at 80% of plant capacity. Now, the variable manufacturing costs, direct material, direct labor, and variable overhead, per unit is $8. The fixed manufacturing cost is $400,000, but quite often you see we express that fixed cost as a unit cost of $4. But beware, because it says 4 per unit, it's not a variable cost, it's a fixed cost that has been unitized. Now, it appears that the cost to produce a blender for us is $12, and therefore we sell it for $20. However, this Mexican company wants to purchase 2,000 blenders, and they only want to pay us $11. Now, this order will not affect our other customers, and obviously we have the capacity to produce this. 2,000 is only a small fraction of the plant capacity would be used. So what do? Well, if I just look at total cost per unit, as I said, the total costs are $12, and I would reject this order because it's $1 less than my costs. However, when I look at the existing plant capacity, that will not increase fixed costs. So therefore, the relevant data, now here relevant means future cash flows that are different between the alternatives, is therefore the variable cost of 8. So my alternatives here, reject the order or accept the order. Well, if I reject, I get no cash coming in. I do not have to produce them. So there's no cash going out. There's no effect on my net income. But if I accept the order, I will have a cash inflow of $22,000. And I produce those 2,000 units. They cost me $8 each. So my cash outflow is $16,000. So I'm $6,000 ahead by accepting this order, especially. Order. Now, the make or buy decision. Here we focus only on costs. These two alternatives, we're going to choose the one that is least costly to us. Now, if I shut down my production and buy in, then I have what's called an opportunity cost to use that freed up production capacity for another purpose. That's called an opportunity cost. Now, an opportunity cost is revenue that I forego because I did not choose that alternative. So if I forego revenue that is a possibility for one alternative, that becomes a cost to the other alternative. And we call that an opportunity cost. For example, here we have Barton Company that incurs the following annual cost in producing 25,000 ignition switches for motor scooters. Now, to do these 25,000, it costs them direct material, 50, direct labor, 75,000, variable manufacturing overhead, 40, fixed cost, 60, total 225. So right now it looks like it costs me $9 to manufacture these products. So along comes another company that says, hey, don't manufacture, shut down that production capacity and buy from us at $8 per unit. And it looks good. It looks good. At first glance, it appears that management should buy the switches for $8 instead of making them for $9. However, when we look at operation and look at cash flows, we could see that if I shut down, I don't have to make, so I'm going to save direct material, direct labor, variable overhead. But the fixed overhead I cannot get rid of. It's capacity. It's the plant capacity, it's the idle equipment and depreciation on that idle equipment, and so on. I can only get rid of 10,000 of it. So when I look at the analysis on a cash flow basis, the make alternative, incremental, is 50,000. So if I buy, I will save 50,000 in direct materials. I'll save 75,000 in direct labor. I'll save variable overhead of 40,000. I'll save here not 60,000, but 10,000. Notice the fixed cost, 60,000 if I make, but only 50,000 if I buy. So I only save 10 there. And if I buy, I have to pay out 200,000. So the cash outflow is going to be 200,000. So the net cash flow here is a negative 25,000 if I buy. Okay. So I will not buy. I'll continue to manufacture. However, along comes, assume now that if I buy the switches, I can use that release capacity to generate additional income of 28,000. Now, that lost income is an additional cost of continuing to make the switches. And the opportunities cost is added to the make decision for comparison. And when I add it to the make decision, then the buy decision becomes more attractive. Now, quite often managers are faced with retain a piece of equipment or replace it with a new piece of equipment. And when you analyze that, you generally think the variable manufacturing cost is what's relevant and the cost of the new equipment. It's true. Now, when considering to replace an old piece of equipment, the amount we paid for that old piece of equipment is called a sunk cost. The book value of that piece of equipment. Now, the book value is what I paid for the equipment minus depreciation up until this point. Like if I paid $10,000 for a truck and I depreciated $6,000, my book value is $4,000. Both of those, the book value and any amount paid in the past, should not affect my decision here. However, if there's a trade-in allowance, that's a future cash inflow. But you see, what I paid for the old piece of equipment is a cash outflow in the past, and I'm only focusing on future cash flows. So here we have Jefferson Company, a factory machine, a book value of $40,000, irrelevant, a remaining useful life of 4 years. The new machine will cost $120,000 and will have a zero salvage value at the end of 4 years. If the new machine is acquired, variable manufacturing costs are expected to decrease from $160 to $125 annually, and the old unit costs will be scrapped. So here, the decision is whether to keep this equipment for the next 4 years or replace it with a new equipment that will last 4 years. So what is relevant here is the cash outflow. If I retain, the cash outflow is $640,000. If I replace, the cash outflow is $150,000. So the difference here is a saving of $140,000. But the cost of the new machine is a cash outflow of $20,000. When I net those two together, obviously, I have a net benefit of replacing that piece of equipment. So the decision would be to the company's advantage to replace that equipment. The lower variable cost due to the replacement more than offsets the cost of the new equipment. The sunk cost and the book value of the old equipment are irrelevant, and they do not affect our decisions in the future. Those costs are in the past. Lastly, we're looking at eliminate an unprofitable segment. In deciding this, we must choose the alternative which results in the highest net income. Often fixed costs are allocated across these product lines or segments, and the unprofitable segment is absorbing their part of the fixed cost. So it's therefore very possible that the net income will decrease when an unprofitable segment is eliminated. For example, here you see we have Pro, Master, and Champ. Now, Pro shows a profit, net income of $200,000, Master $48,000, but Champ $20,000 loss. So if I eliminate Champ, I do not eliminate that $160,000 in fixed costs, and I have to allocate it to Pro and Master. So actually, my profits, instead of going up by that the loss on Champ, goes down. Because, you see, if I continue, I have a net income of Champ. It shows a net loss of $20,000, but if I eliminate, that net loss will be $30,000.